Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for the segment, we have Calcagni, Chief Investment Officer of Mercer Advisors, to discuss what the debt ceiling is and why we're having such a painfully difficult time trying to achieve a balanced budget. Don, it's great to see you as always. Welcome back to Trade Talks.
Great. Thank you, Jill. It's great to be here.
You got it. And what is the debt ceiling and what purpose is it supposed to serve?
Yeah, the debt ceiling is a law that was passed originally in 1917 with the goal of attempting to control government spending. And, the irony, Jill, is here we are over 100 years later, and by any objective measure, it's been an abject failure because it has not controlled government spending. We're currently at $31.4 trillion in federal debt. So by any measure, as a public policy matter, that particular law has failed to rein in government spending.
Why is achieving a balanced budget so painfully difficult?
Well, the reality is when we look at federal spending, when we look at what we spend our dollars on, most of it goes towards Social Security, Medicare, Medicaid, defense spending, and interest on the existing debt. I mean, after you account for those programs, Jill, there isn't a whole heck of a lot left over. And so the challenge is, if we want to achieve a balanced budget, it's really difficult to do so without cutting any of those highly cherished programs. At the same time, nobody in Congress has an appetite really for raising interest rates, certainly not within the House. Certainly there's more appetite for that among Democrats and in the Senate. But at the moment, there's really no appetite to increase taxes or to cut any spending on any of these highly cherished programs.
So focusing on the immediate situation, where do you think we stand? What does it look like the federal government will run out of funds to pay its bills?
Yeah, I mean, unfortunately, we just learned a short while ago that Republican negotiators walked out of the debt negotiations with the White House. And, the reality is if they don't cut a deal, Jill, it looks like sometime on or around June 8th is when the US Treasury will run out of money to pay its bills. Now, there's some variation around that estimate. It could be as early as June 1st, as Treasury Secretary Janet Yellen has reminded us. Other estimates put it further out into late June or even into July. It's really difficult to precisely forecast when the US Treasury is going to run out of money because forecasting tax revenues is exceptionally difficult. But right now, the best estimate is sometime around June 8th.
What's Mercer's view? Do you think the government is going to default?
Right now, our base case, Jill, is that the government is not going to default. Even the recent theatrics with the Republican negotiators walking out of negotiations, hopefully that's a last minute negotiating tactic. But, yesterday it sounded fairly optimistic. Again, our base case, we think, is they're still going to cut a deal. It'll probably be at the last minute. We are expecting a lot of political theatrics before we get there. And we also should expect, and we're counseling our clients to expect some market volatility before we see a deal come out of the White House and the Congress.
If the US government does default, what do you think the market and economic repercussions will be? Would it get that bad?
Our view is that it would actually be quite severe. We would expect to see about a 5% decline in GDP growth. And just to set some context, Jill, for our viewers, that's on par with the economic recession that we saw during the global financial crisis of 2008, 2009. So that would be a very severe contraction in GDP growth. We expect a stock market sell-off of somewhere around 20%. And across the economy, and I think this is the big issue for all of us as citizens and consumers, is we would expect interest rates for everything from automobile loans to home mortgages, credit card balances. All the interest rates for all of those would go up, and perhaps quite dramatically.
So if we were to get a default, that means Social Security checks aren't paid. Clearly that hurts the economy. If no one has any money to spend, you're not going to see any GDP growth at all. But I mean, that's kind of catastrophic if you live month to month and you need your Social Security and disability payments and so forth.
Absolutely, Jill. I mean, I can't emphasize that enough. To think that the federal government could somehow prioritize what it spends dollars on in the event of a default is just not realistic. The federal government is a very large organization. I think it is very, very possible that Social Security checks are delayed, Medicare reimbursements are delayed, and certainly a variety of other government expenditures would also be put on hold or delayed.
So what is Mercer Advisors doing to prepare for the unlikely possibility of a U.S. government default?
Well, first and foremost, Jill, we continue to closely monitor events in Washington. With respect to our clients, we're counseling against trying to go to cash or somehow try to time the market. It doesn't make a lot of sense to move a significant part of our portfolio to US dollars when indeed the issuer of those dollars would effectively be in default. But we're also trying to remind folks that this really isn't a default due to an inability to pay our bills. This would be a default due to an unwillingness to pay our bills. The US government has massive revenues. Certainly, they could always make changes to tax policy. The government owns a significant amount of assets. So it's not like the US government would be insolvent in the more traditional sense when you think of bankruptcy. So lots of education, closely monitoring events in Washington, and of course, always very carefully paying attention to our portfolios, making sure that we have lots of non-US exposure to hedge against a decline in the value of the dollar, and making sure that our portfolios continue to be exceptionally well diversified.
All right, Don, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.